We're going to deal with a bunch of important points here when it relates to capital gains and losses for individuals. These are important aspects for tax planning for individuals as they can significantly impact one's overall tax liability. Below, we've got some key points, including various tax rates, timeframes, and specific circumstances that apply to capital gains and losses. First off, we've got the gross income inclusion. Capital gains and losses are included in an individual's gross income, which is then used to determine their taxable income and overall liability. This is also why I definitely recommend being familiar with the tax forms, specifically in this case, the 1040. You get to see which items eventually flow into AGI and overall taxable income. Long-term capital gains. These are gains on assets held for more than a year, as we talked about. They're subject to preferential tax rates, which vary based on the taxpayer's AGI. Now, these are the rates 0, 15, and 20, and these are related to AGI thresholds, which do change year to year. We've got those in our resources. Make sure you're familiar with those dollar amounts. So if you make under a certain amount of money, it's 0%. If you make between $2 amounts, it's 15%. And if you make over the maximum threshold, it's just a flat 20% tax rate on those long-term capital gains. Again, those do change year to year, so make sure you're familiar with those dollar amounts. Short-term capital gains, these are gains on assets held for 1 year or less, and these are going to be taxed at the taxpayer's ordinary income tax rates. Whether it is this lesson or any others, make sure you are, again, having an incredible attention to detail on what the question is asking. Unrecaptured Section 1250 gain. This gain is subject to a maximum tax rate of 25% and relates to depreciation recapture on real property. We'll go over depreciation recapture in other lessons as well. But this is something, these are just points to memorize and be familiar with. Collectibles and qualified small business stock gains. Just memorize here that these gains are subject to a maximum tax rate of 28%. You sell your collectible toys or action figures, that would be 28%. This rate applies to gains from collectibles such as art, antiques. All right, I guess that's more of a mature collectible, but stamp collection, whatever that is. And a C corporation stock that meets the requirements for the QSBS. Not too important with the qualified small business stock, but just to know that there. This net capital loss deduction, this is what we've talked about before. If an individual has a net capital loss, they can deduct up to $3,000 per year from their taxable income. You cannot carry this back at all, whereas we'll see for corporations, you can have a carryback, but unused losses can be carried forward forever and ever and ever. Personal losses for bad debt. These losses are treated as short-term capital losses and are recognized only when the debt becomes completely worthless. So if you make a non-business loan to someone, that would be the case here. And stock, losses on stock are deductible only when the stock becomes completely worthless, such as a Section 1244 worthless stock. And again, we will see these in their varying importance through questions and get you familiar with them as you need to be. We've got an example here for non-business bad debts. A cash method taxpayer lent a bona fide non-business sum to a friend in year 1. By the conclusion of year 2, it becomes apparent the taxpayer is likely to recover only 30% of the principal and no interest has been or will be received. How should the loss be reported for tax purposes in year 2? Great question, I'm glad you asked. Well, no part of the loss is deductible in year 2. A taxpayer is only allowed to claim a bad debt deduction in the year that the debt becomes actually worthless. The taxpayer does not need to wait for the debt's due date to assess its worthlessness. A debt is considered worthless when there is no longer any possibility that the owed amount will be repaid. As a result, a partially worthless non-business bad debt cannot be deducted. You have to wait until it is finally, and this maybe is years later, it's finally declared, maybe it's in court, maybe it's through bankruptcy. There's an actual reason that you can record on the books you are not going to receive this amount. All right, another great example done. Let's keep moving on. All right, here's a big, great example. We're going to run through a bunch of points here, get you ready for the exam. Let's assume that an individual taxpayer, John, has the following capital transactions during the tax year. You got a short-term capital gain on stock A of $5,000, a short-term capital loss on stock B of $3,000, a long-term capital gain on stock C of $12,000, and a long-term capital loss on stock D of $8,000. Now we saw how we are going to deal with this before. We're going to net those losses together, and what do we get? We're taking our net short-term capital gain or loss, net long-term capital gain or loss. We're netting those together. That gives us a $2,000 net short-term capital gain and a $4,000 net long-term capital gain. Next step, we're going to combine the net short-term and long-term gains to determine the overall net capital gain, which is going to be $6,000. Next up, we're going to calculate John's tax liability for the capital gains. Assume that John's ordinary income tax rate is 24% and he's not subject to the net investment income tax. Short-term capital gains are taxed at ordinary income tax rates. So the tax on the short-term capital gain is going to be the $2,000 times 24% for $480. And then the long-term capital gains are taxed at preferential rates. Now let's assume that John qualifies for the 15% rate. The tax on the long-term capital gain is going to be $4,000 from his long-term capital gains times 15%, which gives us $600. So the total liability for all this investment is $1,080. In this example, John has a net short-term capital gain of $2,000 and a net long-term capital gain of $4,000, resulting in a total tax liability of $1,080 for capital gains. If John had net capital losses, he could use them to offset his capital gains and reduce his tax liability. Individuals can deduct up to $3,000 of net capital losses against their ordinary income each year, which, again, make sure you memorize that. That's going to pop up when you least expect it, with any remaining losses carried forward to offset gains in future years. For example, if John had net short-term capital loss of $4,000 and a net long-term capital gain of $6,000, he could offset the $4,000 loss against the $6,000 gain, resulting in a net long-term capital gain of $2,000. John could then deduct any remaining net capital loss against his ordinary income or carry the loss forward to offset gains in any future years. All right, another great example. We're going to learn by doing, and we will keep doing just that. Now we're going to see a great example here of netting together the various types of gains and losses. Here we see that an individual with gross income of $100,000 had the following gains and losses from capital transactions during the current year. We had a loss of $15,000 on the sale of a vacation home held for 6 years, a gain of $6,000 from the sale of stocks held for 3 years. You've seen this one before. We know that that's going to be capital gain. Loss of $7,000 on the sale of corporate bonds held for 9 months. And lastly, loss of $3,000 on the sale of a sculpture held for investment for 12 years. Now, this is important to keep in mind for the sculpture. Vacation home, we are going to actually completely ignore this in terms of calculating the capital loss that we going to carry forward. Because vacation home, this is personal property. We are not allowed to deduct this loss, just like a loss on selling your car. That is a personal asset. Now, if this was a rental property, that'd be a whole different story. Schedule C, dealing with that. So yes, that would be allowed. If your car is used for business, yes, you would be able to get that benefit. So just some things to keep in mind. Again, if this was a sculpture, just an art piece, that would be different than if this was held for investment. So we'll see the treatment there. Taking into account the amount of time as well, that is going to be important for long-term versus short-term recognition. There's a lot to dissect, obviously, as I'm running through this. And what amount of the capital loss should they carry forward? That's a lot different. They could also ask you, what is the total long-term capital gain or loss? What's the total short-term capital gain or loss? What's the amount of ordinary income here? What's the amount disallowed? You could see a whole sim on this where you have to classify various different types of assets as what they are, what the tax treatment of them is going to be. Lots of ways this could give you trouble in the exam. We'll prepare you properly for it. Here, like we said, the losses from the sale of personal use assets are not deductible, so we're going to completely ignore that $15,000. The $7,000 loss on the corporate bonds, that's a short-term capital loss. And also we have a loss on that sculpture, which is a long-term capital loss. The $6,000 long-term capital gain is offset by the $3,000 long-term capital loss. We've got a long-term on that stocks, the $6,000, leaving a net long-term gain of $3,000. Right, we're netting these two together. And then we are going to take into account the $7,000 loss here. So the net long-term gain of $3,000 is then offset by part of the short-term capital loss, leaving a net short-term capital loss of $4,000. So $7,000 minus $3,000 gives you $4,000. Again, it's super tricky because the total loss here is $4,000, but we have to remember our sneaky rule that will pop up everywhere. It could even pop up, you'll see in partnerships, where you're dealing with passive losses that flow through to the individual. We are only able to deduct $3,000. So if the question asks, what is the total amount you can deduct in this current year? It's $3,000. What's the total amount that you will be able to deduct because of all these transactions? It's $4,000. However, the question here is asking, what can they carry forward? And that is only $1,000. So again, seeing how these types of questions could, you change one word, it asks for another thing, it changes everything. Make sure your attention to detail is superb. All right, we see some other points here. Capital gains and losses are grouped by tax rates. So we've kind of seen this and we're building on it as well. We've got short-term ordinary tax rate group. We've got the long-term 0, 15, 20, which we saw as well. We've also got the long-term 25% tax rate group for the unrecaptured Section 1250 gains. And then we've got the long-term 28% tax rate group for collectibles and the QSBS. Now, gains and losses within each group are combined, as we've been seeing so far, resulting in a net gain or loss for each group. All groups have either net gains or net losses. They are taxed and deducted separately according to their tax rates. Now, if some groups have net gains while others have net losses, the process becomes more complex, and we will have an example demonstrating how this all works. In this case, long-term losses are used to offset short-term gains, and short-term losses are then used to offset long-term gains following a specific order based on the tax rates. Now, key points to remember here. This is super important, the order, because if you don't know this order, you're not going to be able to answer the questions. Short-term losses offset long-term gains in a specific order. We start with the 28% bracket, then we do the 25, and then we do the 0, 15, 20. Long-term losses from the 0, 15, 20 group offset other long-term gains, starting with the 28% group, then the 25% group. Any remaining losses offset short-term gains. Then point 3, long-term losses from the 28% group offset other long-term gains, starting with the 25% group, then the 0, 15, 20 group. Any remaining losses then offset any short-term gains. And then lastly, the 25% tax rate group. This is from the unrecaptured Section 1250 gains, which we don't have to worry about what this really means right now. Just memorize that it is a item in this 25% group. You can only have long-term gains, not long-term losses. So when it comes to items such as these, again, I know this is incredibly complex, and I know that there is a lot to remember, but that's why we will have numerical examples to demonstrate how this all works. Feel free to screenshot this, pull this up on another screen, or write it down to have up as you answer questions related to this. As promised, we've got a great example here, which is going to go through all of those intricacies that we need to see when it comes to netting all of these various types of gains and losses. We're going to consider an example here where a taxpayer has gains and losses from various investments. We've got some from the short-term ordinary tax rate group. We've got short-term capital gain of $4,000, short-term capital loss of $2,500. We've got some from the long-term percent tax rate group, which is $6,000 of a long-term gain and $4,000 of a long-term loss. We've got some from the unrecaptured 1250 gains, the 25%. That's going to be $5,000 long-term gain there. And then some from our collectibles, which is long-term gain of $3,000 and a long-term loss of $1,500. First, what are we going to do? We're going to net everything within the group. So everything except for the 25% bracket has a gain and a loss that we have to net together. And that's the process here. We see we're netting them all together. We see if there's a gain or a loss in each of these categories. So take a look there. And then now we're going to follow the netting process, which is what we went through on the previous slide. We're going to net the long-term capital loss from the 0, 15, 20% tax rate group to offset other long-term capital gains, starting with the 28% tax rate group. In this case, the $2,000 long-term capital loss offsets the $1,500 long-term capital gain. These terms and phrases really take a lot out of me. From the 28% group, leaving a remaining net long-term capital loss of $500. So let's see, what did we do there? We took care of our $2,000 here. We're done with that. And we took care of our $1,500. So we took care of that. The remaining $500 of the net long-term capital loss from this group is offset against the $5,000 long-term capital gain from the 25% tax rate group, reducing it to $4,500. So as a result, the taxpayer is going to have the following, and it's pretty much just our $1,500 from the short-term capital gain taxed at the taxpayer's ordinary income tax rate. And the reason why we net these all together here is because they have the same general tax treatment. They're long-term capital gains. So we can net those together. Even though they have different rates, this is how it's going to play out. We're going to have $4,500 taxed at 25% here. No net capital losses are available for deduction, as all losses have been offset against capital gains. All right, great example. Let's keep moving along, prepping you and getting you ready for the exam. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of cpa.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.